Welcome to the Yorkshire Shadow MPC, a partnership between Recognition PR, Clive, Owen LLP and the York Press. Will the Bank of England follow the lead of the ECB and hold the interest rates? Inflation in the UK was up very slightly in December to 4%, with rises in tobacco and alcohol prices behind the surprise rise. And how much will the Red Sea conflict have an impact on our economy, with the Houthis firing missiles and America and Britain responding? Let's see if our members think it's time for an interest rate cut, and if it'd be good for this region and the economy, and also their own sectors. Let's see if stability is still the way forward. We have a range of businesses from all round Yorkshire for this Yorkshire Shadow MPC. Let's start though with the CBI, and we got Becky Hart on. Becky, what are your members saying to you? Is there an emerging consensus about how the economy is performing?
Thank you very much. I think in short it would be resilient but stagnant. So I think there's they're quite pleased that we've not fallen into recession. However, not really seeing those sort of drivers that would help them invest. Are struggling a bit with access to finance. That's gone right to the top of the tree of the sort of things that are putting a dampener on business growth. And I think also the Red Sea is starting to have an impact on Yorkshire and Humber businesses. It's slowly but surely, but it is definitely growing.
All right, Becky, thanks. Gary from Evelyn, Gary Smith, the Red Sea, Becky just mentioned there. I checked the oil price before we came into this recording, and it was at $83 a barrel. It'd been 78 a couple of weeks ago. But unlike this time last year, the pound is slightly different against the dollar, so we're insulated a bit more. What's your take on general affairs and how your clients, who tend to be wealthy individuals, taking the economy?
At the moment, we are extremely busy. We're approaching the tax year end, and companies and individuals are seeking to invest to use their pension and ISA contributions. The geopolitical issues are of a concern. The markets did rally well at the back end of last year on the expectation that central banks around the world will start to reduce interest rates this year. It is still priced in that will be the case. But if we do see inflation because of the Red Sea, that could impact upon that and markets could come off. So geopolitical issues are causing volatility. We also have a general election this year, and that is making people advance their planning ahead of that. So people making pension and ISA contributions again straight in the new tax year after the 6th of April. But on the whole, things are very positive. Pensions and investments have gone up. So yeah, very busy indeed.
And what about the big indicators for this country, the tax rates and so on, that are being debated before the budget? Is that impacting on people's investment decisions now? Are they trying to get ahead of potential changes? Yes.
So even ahead of any normal budget, there are whispers about what might happen and people plan accordingly. The big rumour at the moment is inheritance tax could be scrapped, but we do have a general election probably in October this year, and we don't know which government we're going to get, but certainly Labour have indicated what they would do from tax in terms of VAT on private schools, tax in non-doms. But there are worries that ISA rates or pension rates could be reduced. So people want to use those allowances. And if inheritance tax is scrapped, it could be very short-lived. So it is difficult to plan when we have such a short period between the spring statement and the next general election.
And capital gains tax changes in April as well. It's virtually not the tax rate, but the allowance against tax. So small capital gains changes, capital gains can be taxed now. What's it going to?
£3,000 per individual.
All right. OK, let's move on to our next contributor. We'll come back a little later, Gary. And we've got Philippa from Clive Owen LLP. Hello. How are your clients feeling in the new year?
I think there's definitely a fair amount of caution. The clients that we've had discussions with, they are definitely still feeling the pressure on salaries, which is very much driven by kind of the employee, but also the market. So costs are a difficult one to bring down because you need your people to be able to do what you do. So that is a concern that's definitely coming up. And a bigger investment in ESG. More and more people are looking at that side of things. So if we can cut costs in one way, bringing in the sustainability and focusing on that.
Okay. Do you think that people are feeling the pinch at the moment, or is there optimism? How would you heard resilience was the phrase that Becky Hart used, but she talked about the resilience in a flat economy. What would your experience from the front line suggest?
Unfortunately, definitely not optimism. I think, there's that constant caution of what to come next. So, yeah, I think it's definitely a very, very cautious market out there at the moment. People don't know what the next step would be.
Okay, let's go to Richard Peake from the Helmsley Group. Remind us the kind of investments you're involved with in property, Richard.
Well, we're buying a lot in York at the moment, a lot of retail, primarily focused around the Coney Street redevelopment, where we're hoping to effectively create a brand new riverside frontage for the city, for the good of everyone there. New leisure offerings, new, more tenant-specific and tenant-relatable retail offerings for smaller occupiers. We buy quite a lot of well-let commercial investments as well for our client investors. We're still very active in the development finance provision to small builders around the country as well. So it's quite a wide range of bits and pieces. But I think the two of the words that jumped out before are sort of caution and stagnation. And I was thinking this morning what we were going to say, but I found this last quarter a very, very flat one, and there's been a lot of people just sort of sat on their hands. Not a lot of stuff's been going on since the last time we all were doing this. I think people are just a little bit nervous in terms of what's going to go on over this next 6 months or so pre-election, and if they don't have to move, probably not moving. There are, interestingly, quite a number of sort of commercial companies looking for specific requirements in terms of moving their operation, but that's definitely driven by sort of one-off business needs from that. So it's not. I wouldn't say it's a new improved confidence in the market. So yeah. Cautious and stagnant, unfortunately, I'm afraid, at the moment. I can't give you a very positive picture.
Pulling out of your own specialty, the actual property element of it, when you look around York, York is always a hot city. It's a tourist attraction that's got a university. It's a busy and lively city. Do you see that York is being impacted adversely by anything in the economy at the moment?
Not compared to the rest of the cities around us. I think York has always had a very good reputation of being a little bit of an economic bubble from that point of view. I can very confidently list a number of significant retailer inquiries, restaurant inquiries, all untapped demand for people wanting to come to the city. But that's because it's got this sort of the tourist base that goes with it and the economy that feeds off it. So I think if you look at the wider region, then it's probably a little bit of a sort of a bleaker picture. But York, we don't see it being affected particularly at the moment from that side. It's certainly there's a lot of people wanting, companies and retailers wanting to come to the city at the moment. Okay,
now let's move to our other sponsor or partner in this. That's Steve Lowe from Local IQ, which of course published the York Press and so on. Steve, I suppose my PR firm and your advertising-led kind of offer will give an indication of the forward economy, because we get inquiries before investments sometimes. What's your take on things at the moment, Steve?
Steady, I think, is mine. We've noticed the high street, whilst Richard is saying about York, has been quiet post Christmas, more quiet than most retailers expected. We've got quite a lot, to Richard's point, we're doing quite a lot of work with people that are investing in buildings in York and transforming them, particularly into the retail, into leisure and hospitality space, which is really interesting and exciting for York. You mentioned the universities. they're challenged at the moment because the overseas student rules have changed on the ability to bring friends and family to come and study in the UK, and so that's having an impact on overseas student numbers. And public sector finances are challenged. Not too bad, but other cities in Yorkshire are having a difficult time, and I worry that will roll into the private sector when they're not investing and spending. So cautious, I think, is.
And in terms of the actual advertising spend, have you to dipstick this week compared to this week last year? Well,
we are on year growth from going into COVID, which kicked us, big time. And this year we are tracking ahead of last year. So all right, very digital. A very digital business now.
Okay, thanks very much, Steve. Let's go back to our panel. And now we haven't talked to Rob Lazenby from Castle Employment. Rob, employment certainly factoring in the tailwind of some of these investments on the positive side is more employment. The front end of negative is less employment. What are you getting through the front door?
I think when you look at it cross-sector, we have seen an increase from the start of this year, 2024, in comparison to when we last spoke in December, which is coming towards the end of Q4. It's definitely picked up the amount of job flow coming through. Although if you're looking at it in comparison with maybe last year, the year before, coming out of COVID, normally we see a lot more of an increase come January, so it has maybe slowed down year on year, although there has been an increase from month to month. We're still seeing certain sectors really performing strongly, so like the engineering sectors, there's a lot of activity on the job side there as well, and still seeing these niche and very high skilled roles are always in demand as they ever are, really, right across varying sectors. I think when you look at the conversations that we're having with our clients at the moment across the region, we're talking a lot about retention, how they're keeping their staff, how they're developing them to keep them on board. And we're also having a lot of discussions around the impact of the national living wage increases come April. And that's something that a lot of our clients right across, doesn't matter what sector, are impacted by. And we are speaking to certain clients who would normally pay above and beyond the national living wage, but they're having to really readdress what their
the differential being different. Yes,
coming into April. And the REC, our body, are saying still there is a high demand in temporary and fixed term contracts, although that's not something that we're seeing as a company at the moment in the region.
I'm going to flip back to Gary in a minute on the national living wage, because there's an inflationary element to that. I'll get a bit of a comment. Dave Broadbent, we haven't heard from you yet, Begbie's trainer. Remind people that you do what kind of accountancy specialist work you do.
Yeah, so we're insolvency practitioners. So we're sort of front end at the coalface when it comes to businesses that are struggling. I think everybody's heard my doom and gloom comments for the last probably 6 to 12 months now. We've picking up basically what everybody's been saying, where Becca was mentioning about the fact that
clock's right twice a day, isn't it?
I mean, Becky was saying earlier about lack of cash. So that we're seeing a lot of at the moment. The businesses are struggling as a result. Cost of living again, dropping demand and turnover. A lot of businesses at the moment are quiet. Bizarrely, the ones that are doing well are your restaurant type businesses. It seems to be still a huge amount of people wanting to go out and eat. The biggest issue that we're seeing at the moment, the biggest driver for businesses having to come to a decision, is because the white elephant in the room has eventually decided to wake up, which is the revenue and customs. They, for probably since COVID, have not been recovering the amount of tax liabilities that the UK was owed at the sort of rate that they've historically done, whether it was as a result of just trying to help the economy to get back on its feet, or whether it was just by virtue of that they knew there was so much borrowing out there already but the revenue and customs are now starting to recover.
There are quite a few reports, aren't there, about zombie businesses that really shouldn't be trading because they're because they're cash flow and so on. I suppose the revenue and customs are the likely axeman who are going to thin out the zombies, I suppose.
Yes and no. Revenue and customs are generally one of the biggest drivers for an insolvency to a certain extent, because they effectively accelerate the recovery procedures that makes people have to make the decisions to close companies, etc., etc. Zombie companies are still mainly driven by the fact of a lot of the COVID borrowings that took place 3 years ago now, where people simply aren't in a position to repay that bounce back loans, not so much the CBILS because those were much bigger, but certainly the bounce back loans. I'm speaking to probably 100 people a month at the moment, majority of which are small owner managed businesses that are struggling to repay the bounce back loan. They just can't afford to make the repayments. If you take, for instance, a £50,000 loan that was taken out in 2020, repayments on that are around about £800, £700 a month. Businesses are just struggling. So what the revenue we're doing is tipping over a bit.
So we don't leave your contribution feeling completely depressed. Of the 100 people a month you speak to, how many do you get a positive outcome from? 4.
It's not a big number. We are able to rescue quite a few businesses. Those that we are rescuing, it's mainly because there's the creation of a new entity.
100. So give us out of 100.
Taking the business going forward.
Go on, give me a guesstimate. Give me a dipstick.
Quarter.
25%.
Less than 25.
I'm going to have to go back to Gary now. He's got to cheer me up a bit. Come on, Gary. What do you make to that?
Yeah, I think it was always expected. Interest rates are biting, both from a personal perspective in terms of mortgage costs mean people have less money to spend in the economy. Those with savings are holding money on deposits and not spending. So a recession or a shallow recession was always expected, and they've been busy isn't a surprise. And we probably need a recession because otherwise, we need inflation to slow down and for the Bank of England then to reduce interest rates, which reduce borrowing costs, which then enable people to go out and spend. We have had the first month where people might see the reduction in national insurance coming through into their pay packets. So that might help a little bit. But fundamentally, we need interest rates to start coming down. Inflation coming down is the only way that will happen. And assuming that we have these geopolitical issues do not escalate into full-scale war, then hopefully inflation will continue to come down. We have the energy cap coming down in March. And if inflation does trend downwards, interest rates will come down, things will improve, and we shall hopefully only have a shallow recession, and Dave will be able to put his feet up towards the back end of the year.
Yeah, you won't want that. I won't want that. Philippa, before I go to our final contributor, which is Chris, my own business, because I get a little bit of a say in this as well, my own business has done relatively well in the month of January. Pipeline has come through. The phone has been ringing with people who are planning things in a few months' time. So it's been pretty optimistic. But the one thing I've been hit with, because I technically am self-employed, it's an LLP, it's not a limited company, is the government's basis period reform. Now, Philippa, do you have a number of clients that have had to go through basis period reform? Because I've chosen to regulate my tax year along the line of what the HMRC are saying, it means a bit of catch-up on tax, which takes cash flow out. Philippa, do you see that with some clients?
Absolutely, and I think that's exactly what people or the businesses don't want and the clients are not wanting. But it's
just sort of interrupts the planning, doesn't it? It makes your tax planning more for 1 year only. It just means a bit tighter squeeze because the revenue are changing the dates in which your tax year is. It's not actually more tax. It's just rescheduling.
No, it's just the timing, which is together with the pressure of everything else, it's that added pressure. And I think cash flow is the one where, as much as it's predictable that you can look at forward and look at what needs spending, you put a crunch on cash flow, especially at this time of the year where you've got your taxes to pay, you've got your business that you've got salary increase coming through, you've got those kind of things. It's added pressure that people probably just didn't need at this stage, to be honest with you.
Okay, let's round up with Christopher White, Chris from Ecology Building Society. I was looking at the average 5-year fix for mortgages, and it's come down. It's 5.18%. An average 2-year fix is 5.56%. Are these reductions in mortgage rates now encouraging people to come forward and take mortgages out?
Yeah, I think so, Graham. So I was going to say I agree with the kind of group around the fact there's been a lot of stagnation and caution in the market at the moment. But as you say, mortgage rates are probably one of the areas where we have seen some movement over the last month or so. So, yeah, we have seen reductions, and obviously that is positive for people whose kind of mortgages are kind of coming to the end of their current deal in the near future, that they'll be able to kind of refinance those at a greater rate. And I think that's quite important for the economy, to be honest, because I think we've talked about the cost of living crisis and people potentially struggling, and that's something we're very mindful of as a sector and as a business, and obviously them being able to refinance at a lower cost, I think in 2024, now that we've seen some of that rate come off a bit, will be really important. And
what about the price to average earnings of houses? I was looking at that. It's now 5.17% of average earnings. You have to have the house price is 5.17 times average earnings. It's not quite as high as it was a couple of years ago, but it's still 5 times earnings. That's a lot. Yeah, it's obviously been a really significant change in, I guess, the dynamic between people's earnings and the value of the property they're purchasing over the last few decades, I guess, and has increased significantly. I guess I think the mortgage market and mortgage providers are looking to innovate in that space to kind of try and help people be able to access property because of the challenges that presents. And obviously, I guess at the moment with the cost of living crisis, that limits people's ability to save and makes that all the more challenging as well. But like I say, I think innovation in kind of how products are structured for people and how they can access home borrowing is helpful in that space. There was talk this month of the government getting behind sort of lifetime 30-year mortgages. I don't know how they would work, but what's the industry thinking about that? So I think it's a really interesting area and something that borrowers should certainly explore. It's something that's far more common in Europe, a lot of European countries, and the kind of way that they help finance people for mortgage products is structured that way. Obviously, it gives people stability and they know where their kind of product is and who they're with, and it's for a longer term. And I think it's something that the mortgage market's probably looking at. There are challenges in kind of how mortgage providers are able to provide that. They've obviously got to be confident in the ability to provide the finance at a certain price over a certain time, and that can be challenging for financial institutions and for them to manage their margin. But I think anything that helps the consumer is something that certainly the kind of provider should be exploring. Okay, let's get everyone on the screen. Now, I've got to go through the different options. If we were on the real MPC, not the Shadow MPC, if we were on the real MPC this week, we'd have the choice to cut rates, put rates up, or keep rates the same. Now, my vote probably is to keep them the same, but some of me thinks that this rate is not right for the economy. Listening to everyone's views on where the economy is, it is stagnating, and maybe the right thing is to inject the economy with a tiny rate cut, albeit there might be tax cuts coming down the line in a few months. We don't want inflation back. So I don't know, I'm sort of vacillating between saying the bank should go for a tiny cut or hold them. Does anyone want to say that they want to have a comment on this point of cut or hold?
It's too early for that.
Too early?
Even the most optimistic market commentator is predicting May for the first reduction in the UK.
But would you, if you were there, what would you do? Would you leave it to March or May?
Me?
Yep.
At the minute, I would hold. I wouldn't put it down at the moment.
Right. Okay.
What we don't want is the banks being forced to put interest rates up again and mortgage rates going up and borrowing costs. We just need to see a sustained period of falling inflation, and then I think interest rates, my personal view would be September, but the markets have priced in, some have priced in a May reduction.
Okay, right. Let's go for a simple show of hands vote. Does anyone on the panel think there should be a cut in rates this month? 0. Does anyone on the panel feel that there should be an increase in rates this month? 0. By show of hands, does anyone on the panel feel that rates should stay the same? Oh, it's unanimous. A unanimous Shadow MPC for Yorkshire. Thank you everyone for joining us. Thanks to Clive Owen LLP and also our sponsors, the York Press. Join us again in a couple of months where we'll see where the situation is.